Yeah, let's do that. That worked out pretty good. So who wants to open us up here with chapter 11? All right, Brady, go ahead.
All right, so I didn't write down page numbers this week on accident, but I put the major issue that adjusting a business income statement based on random fluctuations of the balance sheet distorts operating, or I put operating, yeah, earnings. As an accountant, uh, it's kind of like when I look at businesses like statements and stuff, I'll skip over the balance sheet and usually look straight at the income statement because that's where the most important numbers are. So it's kind of like a good, not a good place to hide it, but it's kind of smart for them to hide it in the balance sheet because not a lot of people will look at it. And it's, yeah, that's what I thought when I was reading it. Like, wow, that's kind of
Yeah,
smart, but it's bad to do that.
yeah, I think if you train yourself well, you want to look at all of them,
Yeah.
to look at their leverage position and stuff. But I think you're right. The first one you look at tends to be probably that income statement. I think I saw Lawson next, and then maybe JC. And otherwise, if you give somebody that wants to add on a little bit or something, I'll let you jump ahead. But Lawson, go ahead.
Yeah, mine was on 108. It's just talking about fair value accounting have been implemented in all businesses that the global stock markets would have crashed and made the 1930s look like good times. So like, yeah, that's kind of huge, I think.
So yeah, I want to make sure we got with the fair value accounting stuff. I don't know if you want to add on, JC. Let me let you go back for a little bit, and I see Jeremiah up, but let's kind of expand on that. Make sure we're all clear on what how Allison's portraying that. JC, go ahead.
He says on page 108 that fair value accounting simply magnifies the swings in economic activity, thereby over-reporting earnings in good times and exaggerating losses in difficult economic environments.
Okay, good.
So basically, in a good time, he's overestimating the good stuff, and in bad times, exaggerating it. That's what basically fair value accounting is.
Yeah. Okay. Jeremiah, do you want to add on to that?
Yeah, mine was on the bottom of 104 and 105, kind of explaining the fair value stuff. Fair value accounting was a major cause of the liquidity problems in capital markets. Public companies would not purchase economically valuable assets because of the accounting risk.
Okay.
Yeah.
Who else wants to add on to that? Because I think there's more to say even. Olivia.
Sorry, I came slightly later, but I don't know if anybody mentioned the where it talked about on page 108 fair value accounting and how it wasn't fully implemented back in 2008, and so at least 90% of the public companies would have reported substantial operating losses and everything like that. And I just think that 90% is a very big amount, or a very large amount of companies. And so
Yeah.
I didn't
That's
know
what we've
if
been kind of dancing around here. Aaron?
So mine's on 109 about fair value accounting. And it says the general movement to fair value accounting has created an environment leading to both fraud and honest mistakes by management. I don't know if I'd say it was a mistake. I feel like they kind of did it on purpose to kind of hide what they were doing, but I mean, that's just my opinion. So
I haven't heard anybody really say what it is in terms of the impact that it has on what you have to do, especially if you're a bank. If we want to focus in on banks, if you're doing this mark to market and fair value accounting, what does it force you to do that can be difficult? Jacob?
Fair value accounting kind of takes into account that your assets are valued as if you're under liquidation instead of what their true value is.
Okay. And then in the time of a crisis, when the market's down, what does that mean for your balance sheets in terms of your asset evaluation? Go ahead, Kayla, why don't you unmute? And yeah, I agree with your down arrow, but
I just meant that all of the value of their assets would be going down with it.
Okay, and at least in banking specifically, what do banks have to do if their asset values are marked down?
Would they want to give out more loans?
They would want to give out more loans potentially to get more assets. That's one thing, but there's a kind of a more immediate thing. If the market is, let's say we have a big market correction of 10% and asset prices fall, what do banks have to do to stay in line with regulations? They're a little different than a private company might have to do. Eddie, you got your hand up for other reasons or for this one?
Yeah, it was for other reasons, but they would have to raise their interest rates, right? Kind of like
No, well, they wouldn't be able to do that immediately, but that would be kind of the longer or maybe intermediate term thing that they would need to do. But what do the owners of the bank have to do to be in compliance with the Fed and other regulations?
Put in more capital ratio.
Put in more capital, yeah. So here we've got the market is going down, and so things are rough. We're maybe in a crisis. And then on top of that, because of the regulations in the banking industry, the owners have to cough up more cash and provide more liquidity because they're not allowed with those capital requirements that we discussed a few chapters back. They're not allowed to get that low. Whereas a private company, maybe it doesn't even matter that their value of their, let's say their building or something, their asset value went down. They're still going into work every day. They're making their microphones, and the microphones are coming down the conveyor belt. And the fact that they wouldn't, if their building that they're in was worth $1 million a month ago, and today it's worth 700,000, as long as they didn't have too much debt against it, it doesn't really matter, right? They can just ride out the storm and keep producing microphones. Maybe they have to lay off a few workers or something, but the owners don't have to put in more capital to ride out that problem. Whereas with the regulations with the bank, the owners do. And so that's part of what's going on with this fair mark-to-market accounting maneuvers, is that it's a little more rigid and can cause some problems. Okay, Eddie, you got a different direction to take us?
Yeah, I mean, same direction, but different quote. He said that I also believe that if fair value accounting had been in place and during the recession of the early 1990s, the U.S. financial system would have collapsed. I guess my piece on it was that in accounting, we always talk about, the difference between the two different accounting systems and, maybe doing both of them on a problem. But I don't think I've ever seen like it applied to real life and then how the major downsides maybe to it could be.
Yeah, good point. So those of you who haven't had maybe some of the higher level accounting, I assume you're basically talking about maybe the books that you keep for the IRS versus the books that you keep internally for yourself versus maybe the books that you show the shareholders, which would be usually internally anyway for the shareholders. But the tax preparation is a little bit different than some other books. Is that what you're referring to mostly, Eddie?
Yeah, book value accounting versus fair value accounting.
Yeah, okay, good. Let's see, Bryce.
I think Jonathan had his hand raised before me, if he wants to go.
Yeah, I got this digital thing going and then it disappeared on me. Okay, so Jonathan, yeah. I didn't know if it was actually ordering it, like whoever raised their hand first or not. Apparently not then. If Jonathan, go ahead, Jonathan.
Appreciate that. I don't know if it was my understanding of fair value that was kind of wrong. But my point was how the accounting was misinterpreted. So I don't know if you could just clear that up, because I thought it was just that the downfall that comes from that kind of accounting is that it could be it's because it's based on what they believe to be the market value, so it can vary from one accountant to another.
Yeah, let's I want somebody else to try to tackle that, or what your understanding of that was, for Jonathan to kind of explain that more. Who's up for that? I think we've been kind of hitting around. I think if you think long-term, short-term is kind of part of the key here. Maybe we'll just let that sit out there for a second. If anybody's, I don't see anybody waving their hand, unless Daniel, is that what you wanted to respond to, Daniel? Okay, Daniel, go ahead.
Yeah, like basically there's just no one size fits all. There's like several different ways to skin a cat, so to say. Basically, with accounting, you can approach it from various different aspects, and like I feel like approaching it in aspects that they talked about in the book and how that Jonathan was saying, it's just like there's a bunch of different ways, and they can kind of fight each other if you aren't like careful about it too. Does that make sense?
Yeah, that makes sense because I was thinking more on that line because as I was saying, my point was like it was misinterpreted. So yeah, makes sense. Appreciate it.
I
Thank you.
saw Eddie first and then JC maybe to add on a little bit to this.
I think one of the major things that's wrong with it is that you can manipulate how your company looks. So during the really good times, you can say, oh my God, we're doing so good. During the bad times, you can say we're doing really, really bad, even though you might be somewhere in the middle. And so you can kind of manipulate to where maybe you show the IRS that you're doing super bad, so you need this, or your stockholders that we're doing super good. So, keep doing stuff or keep, raising the price of our stock, but really maybe you're not doing so hot.
Good. JC?
Jonathan was asking about the difference between market price or the market value. That's the price of an asset in the market compared to the fair values, which is the estimate of the assets on the financial statement. So the one is the actual price in the market, while the other one can be estimated, like Eddie just said, whatever number you want to say in the financial statement.
Okay, good. Bryce?
Yeah, so my quote kind of goes off of that. And my quote said, in fact, 2 quarters before it failed, the Lehman Brothers, recorded a major gain or profit from the declining value of its debt, even though it did not actually repurchase any of its debt, which is crazy to think about because that really shows the absurdity of using the fair value accounting.
Yeah. Yeah, and so another thing I don't think anybody's brought up, I can't remember if it's in the text or not, like when December, January comes for your end of the year statement, it's not too hard to shift some expenses into January the next year if you're already going to have, or if you're going to have a loss and you want to make it a really bad loss, some of the expenses that you could have spent in January, you can bring backwards to December. So accounting can get kind of creative and reasonably so creative, but it could be deceptively creative, depending on what motives people are doing to shift expenses one direction or the other. Let's see, Liz, did you just raise your hand or were you stretching? Okay, Liz.
Yeah, it was me. I was reading a page where it was page 112, where it basically kind of brought up like a solution. It said, in China, they would probably be figuring out how to reduce the cost and improve the quality of the next generation of electric technology. In the United States, they're hedging an accounting risk, which is completely non-productive activity. And I just thought, like, if we actually had like that technology to actually create accounting in that way without, having so many people, have so many ways to cheat the system, then we could have probably have some like solution there, but we don't.
Yeah, good. All right, other people, Marco?
Yeah, so mine was on page 106. It says, accounting systems should never drive economic activity. So I feel that every country has good and bad policies, and I feel they should analyze, which ones are the bad ones and to try to change them in their favor and how would best work for them.
Yeah, so are we starting, once we start doing things to letting the accounting rather than whatever we do, whatever we're best at, it's kind of similar to lobbying efforts, I think, too, of if companies have more incentive to lobby their politician and to spend, significant sums of money driving to Washington and trying to get favorites from their some sort of policy plan, that's not helpful, right? That's kind of non-productive. You're just kind of looking for handouts, which will ultimately be a transfer from taxpayers to that company. That's the cronyism that's non-productive too. That's just kind of a similar vein. Okay, who else? Did I miss? Okay, Kayla, go ahead.
There we go. So mine kind of went off of Marco's about how the author said that he was involved with decisions where it was a poor economic decision, but they had to do it because of the accounting policy that was in place.
Yeah. Would have preferred to do it at different timing or something. All right. Anybody we haven't heard from that wants to go? Let me look for newcomers or new people who haven't said anything. We're getting down to last call maybe here. Dakota?
Yeah, I got one. It's on page 112 under where Liz was talking. Can you hear me? All right.
Yeah, it's breaking up a little bit,
My
but
screen's
continue on.
lagging. All right. It says something like only like 10% of all people actually understand I think it says the interconnections among like mortgage servicing rights, and I think that goes to show how easy it is for them to kind of get away with those little things. It said that's why it said that it took years for Freddie and Fannie and Fannie to finally release accurate information that that people can hold true to, and it's they're not kind of bend rules here and there.
Okay, good.
Questions among how easy it is for them to kind of get away and finally release.
Okay, good. I think we got most of the gist. It was a little breaking up for me, but I think we got most of what you said there. Anybody else?
Yeah, my internet's lagging bad.
Okay, no problem. Jacob?
I had a quote from the book that was a little bit later in the chapter. It said, "We now have a heavily government-influenced, in parentheses, like corrupted accounting system, a hybrid that's no more valid or less destructive than the hybrid GSEs at the time." I just thought that was important because it means that we still have some of these structures from 2008 still around today that could screw up our economy just like they did back then.
Yep. I think we'll see the rumblings of it here. It seems to be marching down that path. Don't know when, but I would guess it is. I also saw Bitcoin got up to 50,000 today, so I'm continuing to be long-term bullish on Bitcoin. I'm dollar cost averaging into it even at these high prices. So, all right, last call. All right, so we'll put that one to bed. We got next one, chapters. We got the next two chapters, right? Is that what's due for Thursday, I think? So 12 and 13. And we'll keep chugging along. So today I've got a video queued up and a reading. So I'm going to share my screen. And the reading is from our textbook. Oops, where is it? There we go. So Arthur Andersen is a kind of a famous case, and Lynn, Professor Wagner, was working for Arthur Andersen back in the 80s. So I like to kind of rib her a little bit that maybe she was part of these scandals that went on. It's one of the top 4 accounting firms in the nation. And this is one of their famous cases. So what I'd like to do is do a little round robin reading here on this. So I've got Jacob first and then Marco. So Jacob, if you can unmute and read the first paragraph, and then we'll go on to Marco for the second, and then Kayla for the third.
In 1913, Arthur Andersen, a young accountant who had denounced the slipshod and deceptive practices that enabled companies to fool the investing public, founded his own firm. Until the early 1980s, auditing was the most important source of profits for this firm. By the late 1980s, however, the consulting part of Andersen's business had begun to experience high revenue growth and high profit margins, even as its audit profits slumped in a more competitive market. Consulting partners began to assume more power within the firm, and the resulting internal conflicts split the firm in two. And Arthur Andersen, the auditing service, and Andersen Consulting were established as separate companies in 2000.
Marco? Oh, Marco's not there. Kayla, why don't you take Marco's spot?
Okay, there we go. During the period of increasing conflict before the split, Andersen's audit partners had faced growing pressure to focus on boosting revenue and profits from audit services. Many of Arthur Andersen's clients that later went bust, Enron, WorldCom, Quest, and Global Crossing, were also the largest clients in Arthur Andersen's regional offices. The combination of intense pressure to generate revenue and profits from auditing and the fact that certain clients dominated the business of regional offices translated into tremendous incentives for regional office managers to provide favorable audits for these large clients. The loss of a client such as Enron or WorldCom would have been devastating for a regional office and its partners, even if that client contributed only a small fraction of the overall revenue and profits of Arthur Andersen as a whole.
Let's see, Liz, why don't we go on to you here for this last part?
The Houston office of Arthur Andersen, for example, ignored many discrepancies in Enron's reporting. Arthur Andersen was indicated in March 2002 and then convicted in June 2002 of obstruction of justice for impeding the SEC's investigation of the Enron collapse. This conviction, the first ever against a major accounting firm, barred Arthur Andersen from conducting audits of publicly traded firms and so effectively put it out of business.
Okay, so now, and I think that was, I want to make sure that, yeah, that was it. Okay, wanted to make sure that that was the end. So I've got a short video queued up here on WorldCom. And this will give you kind of another inside taste on corruption and conflict of interest, which is the nature of this chapter. So we got about a 9-minute video here. So I'm going to play it. I'd like to see, once I start playing the video, tell me, I think we should be good with the audio the way I have my microphone set up, but tell me if, so give me a thumbs up if you can hear it. There's nothing right now playing, so hold on. And we can talk and pause during the thing if we need to.
This guy's a law enforcement. Yeah, an independent government agency who, along with the FBI and the Federal Reserve, regulate the stock market and corporate fraud. And the Federal Reserve is the prison. No, basically it's a help and profit bank that sets interest rates and loans money to other banks. Come on, Phil. You're gonna be kidding me. You're Urshan's lawyer. We're turning over investigation to you. Let me assure you, there will be no conflict of interest between me and David Urshan. And if this were an actual investigation, I would immediately recuse myself. This is all the evidence we have, and I truly hope you take this seriously. Yes, very much so. From everything I've heard, I understand you guys are the best at these types of investigations. Outside of Enron, and AIG, and Bernie Madoff, WorldCom.
Meet Bernard J. Evers, born on August 27, 1947, in Edmonton, Canada, to a family of traveling salesmen. Bernard was the second of 5 children. After high school, Evers briefly attended the University of Alberta and Calvin College before enrolling at Mississippi College. During this time between schools, he worked as a milkman and bouncer. While attending Mississippi College, Evers earned a basketball scholarship. An injury before his senior season prevented him from playing his final year. Bernard earned a bachelor's degree in physical education from Mississippi College in 1967, an honorary doctor of laws from Mississippi College in 1992, and also an honorary doctorate from Tungaloo College in 1998. Evers began his career operating motels in Mississippi. He joined with several other people in 1983 as investors in the newly formed Long Distance Discount Services, Inc., and it became a public company after acquiring Advantage Companies, Inc. Soon after, it merged with another discount service provider, Advanced Telecommunications Corporation, which resulted in the name WorldCom. Evers was chief executive of the corporation. As the new CEO of WorldCom, Bernard focused much attention on the aggressive acquisitions of other telecommunication companies. While heading the company, Evers led WorldCom through 17 mergers. In 1996, WorldCom acquired MFC Communications Inc. for $12 billion, which at the time was one of the largest corporate acquisitions in US history. However, Bernard did not stop there. And in October of 1997, WorldCom announced a bid to acquire MCI Communications. WorldCom was not alone in its attempt to acquire one of the largest telecommunication companies in MCI. British Telecommunications Corporation offered $19 billion for MCI, but Bernard Evers was relentless in his aggressive acquisitions and countered BTC's offer with a $30 billion offer for MCI, to which no company could match. The acquisition for MCI by WorldCom was finalized in September of 1998 at $35 billion, with Evers assuming $5 billion of the MCI debt. After the mergers, Evers received numerous accolades from the press for his role as CEO, while WorldCom quickly grew into one of the largest telecommunication companies in the world. The WorldCom acquisition train did not stop there, however, and in 1999, Evers announced that MCI WorldCom was attempting to acquire rival company Sprint Communications for $129 billion.
That fraud started in earnest after WorldCom's deal to acquire Sprint was turned away by federal regulators in the summer of 2000.
With the Sprint deal being killed, it put us in a situation, who are you going to buy of any size? So now you had to turn it into an operations company. And the question was posed, I think, on the street as well as internally is how well would Bernie do as an operating CEO versus an acquisition and growth CEO?
With his latest deal in shambles, Evers faced an additional challenge in the summer of 2000, the most difficult operating environment of his career.
The economy was in trouble, the telecom sector was in trouble, and WorldCom being part of that was in trouble. Certain businesses started to not be able to make their revenue targets. So there was a lot more of customers that we were running across that had not paid their commitments to us.
Of all those customers, the internet companies were in the worst shape.
In 2001, we processed over 100 bankruptcies out of that segment alone, companies that just literally went out of business as customers of WorldCom, and in some cases left us with substantial billings.
The answer? The biggest accounting fraud in the history of corporate America.
They began to draw down on reserves, inflate their income when the reserves, as they must be, were ultimately exhausted. Then they undertook even more brazen efforts at restating expenses as capital expenditures, which had the effect of raising the income.
WorldCom would make good on its earnings numbers for Wall Street by making those numbers up.
If the actual numbers were used and not the cooked numbers, it would show that they missed those.
I want to pause it there for a sec. One of my accounting people, I don't have your guys all full screen here, but what is restating expenses as a capital expenditure? Anybody want to tackle that one for kind of a super bonus, but you're not going to get any super bonus points, but you will impress me. Somebody unmute. So restating expenses as capital expenditure. And then it led to effectively helping out their income statement.
Would it be like understating their profits so they can kind of like keep some of their profits away?
It's actually going to increase profit for a given year by restating your expenses as capital expenditure. And it's kind of a clever little accounting technique that probably was completely fraudulent, but anybody else want to add on to what Eddie said? That you've got kind of part of it. Go ahead, and I can't see everybody's face. I guess I could.
Isn't it like buying, like, let's say land or property and saying it has a value for over a certain period of time, and you say that's an investment?
So that would be an example of like a capital expenditure. So what are you doing when you buy land? How are you getting a tax benefit over time? Anybody could jump in with that one if you wanted, or JC if you've got the answer. Or chat box, we can do, yeah, we can run up the chat box. Oh, Lawson says favorite movie.
Isn't it because you're using that as a piece of your company, so you get tax benefits from buying that land? Because something used to make your business more efficient and productive?
Yeah, let me go to the accounting people. Yes, I mean you're saying some of the right things, JC. But if I buy a $100,000 machine today, this year, and that machine is expected to last 10 years, how does that work for you guys in accounting? How do we show that to the IRS? How do we get tax benefits in terms of purchasing a machine for 100,000 that's going to last 10 years? How do we report that to the IRS?
It's the depreciation and the tax shield that you receive as a benefit for owning the machine that's wearing down.
Okay, good. So if I buy the machine and the IRS says, well, for this type of equipment, you have a 10-year depreciation schedule. And so you're going to take that 100,000 divided by 10 is 10,000. So in 2021, you're going to have a $10,000 expense, if you want to call it that way, or a benefit in terms of reducing your tax liability. So if you made $1 million, you now made 990,000 in terms of taxable profit, right? So you're getting $10,000 worth of benefit. So now back to what the movie just said, to kind of relate it to this $100,000 machine that you bought. They recharacterized it as a capital expenditure. So instead of having a $100,000 expense this year, which was the appropriate way to do it, they recharacterized it as a capital expenditure, which made the expense drop to 10,000, right? 100,000 divided by 10. So now you had 10,000 worth of expenses on the books instead of 100,000 of expenses on the books, giving you a bump up in your profit of 90,000 with that one accounting move. And so technically it's not a choice that you have. The IRS has certain rules. It was this type of expenditure. Sometimes there's gray areas on, well, what type of, depreciation schedule should I use for this particular purchase? The more aggressive the depreciation schedule, if you could do it instead of on a 10-year basis, if you could do it on a 5-year basis, it would give you even more reduction in tax liability today. Now, remember that all of this is separate. To go back to kind of John Allison's book, this is all separate from the actual economic productivity of the machine. So the machine might be fully depreciated after 10 years, but it still might have a 10 additional years worth of useful life, right? It's just as productive. If it's some sort of manufacturing machine, it's just as useful in year 11 as it was in year 1, potentially. And so economic depreciation is different than IRS depreciation. And that kind of brings us back, especially those of you who haven't had some of the upper division accounting classes. That's how you can kind of play with some of the books, and certainly what this WorldCom guy did. So I'm going to start the video again, but any last questions or comments there? All right, let's go back and wrap that one up here.
Earning targets in 11 out of the 13 quarters between 1998 and 2002. And the last 4 of the last 5 quarters prior to the actual bankruptcy, they actually lost money.
Senior managers at the company knew the true state of the business. What they couldn't figure out was how the numbers given investors were staying strong.
The charges filed today are a result of an extensive investigation of WorldCom Incorporated.
In August of 2002, the Justice Department indicted several top WorldCom executives. The charges followed the company's own admission that its profits for the previous 3 years were an illusion. Massive accounting fraud had made a business gone bad look good. The phony income would soon grow to more than $11 billion, the largest fraud ever committed by a U.S. corporation.
And we were astounded on the one hand. On the other hand, the light bulb went off. That's the answer that we didn't understand. And that was the reason that we couldn't understand. That was not only, oh my gosh, but wow, what a relief.
What about anger? I can understand relief and I can understand those emotions, but I have to believe that a part of you thinks about the thousands of employees who lost their jobs, the people you perhaps had to fire because you thought they weren't up to the task.
Think of all the companies that went out of business that assumed that that was real.
At WorldCom, few things were real. It was a company whose business model was built on a lie.
This lie all along was orchestrated and controlled by Evers. Prosecutors in the case successfully argued that Evers was running the show when masterminded this $11 billion fraud that toppled his company and troubled the entire telecommunications industry after. Bernard, with the assistance of WorldCom's former chief accounting officer, Scott Sullivan, chose to lie to their investors and regulators while artificially inflating their company's earnings and stock prices, while also failing to report their missed growth projections. With its rapid growth and numerous mergers, WorldCom accumulated billions in debt. With this looming debt, Evers and Sullivan turned to illegal accounting moves that misstated their revenues and actually inflated their earnings by hundreds of millions of dollars. This inevitably led to the collapse of WorldCom and the federal indictment that would soon follow. A final nail in the coffin for Bernard and the WorldCom dealt with sweetheart contracts and loans that were extended to Evers by WorldCom's board of directors. The board extended Evers $366 million in personal loans and loan guarantees, which he later defaulted on, and they totaled more than $400 million. This wrongdoing sparked an internal investigation 2 months later. In July of 2002, after accumulating $41 billion in debt, WorldCom filed for bankruptcy. After the internal investigation and cooperation from Scott Sullivan, a federal indictment was filed against Bernard Evers in March of 2004. The charges included securities fraud, conspiracy to commit fraud, and participation in filing false corporate records with the SEC. After a widely watched 8-week trial in early 2005, Evers was sentenced on July 13, 2005, to 25 years in federal prison for orchestrating the record $11 billion fraud. His sentence was one of the stiffest in corporate fraud cases ever at the time. Today, Bernard is serving out his sentence at Oakdale, Louisiana Federal Correction Institute after continued failed appeals of his conviction. He will remain locked up until 2027, when he would be 87 years old.
It's beyond me how somebody could behave that way. I don't know how you get up and, if you're a man, and shave every morning and look at yourself in the mirror, how you could live a life knowing the type of things that you're doing, knowing that it's wrong.
All right, so I cancel that, stop the share. Okay, any questions or comments on that? Little hash through, hopefully it fills in a few of the blanks. So as you read chapter 15, it's kind of reading comprehension type of chapter, like I mentioned before. So then it's going to get into government policies like the Glass-Steagall Act and Dodd-Frank and Sarbanes-Oxley. So it's going to talk in a little more details, but I think watching that video and reading through a couple of the cases kind of helps color in the lines a little bit. So we are going to call it a day. Now this is a real record. Yes, I see your faces. I know you're disappointed, but I think that is what we are going to do so that you guys can all, I want to give you guys this extra half hour plus to read the chapter and you can jump in. We're actually going to move into the chapter 20 on international stuff later this week too. So this chapter 15, I've got a couple more things we'll do on Thursday in addition to going over the Allison book, but this will give you a little extra time for our Cold Tuesday modified class. So adios.